Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Wednesday, April 30th. As expected, the Federal Open Market Committee agreed to cut the Fed funds rate another 25 basis points to 2%. In a related action, the discount rate was also cut by 25 basis points to 2.25%. The vote to cut the Fed funds rate was not unanimous. As was the case at the March 18th meeting, Dallas Fed President Fisher and Philadelphia Fed President Plosser dissented, registering their preference for no rate cut. The accompanying directive noted that economic activity remains weak. This is a subtle change from the prior directive in March that indicated economic activity has weakened further. The directive repeated the view that tight credit conditions and the deepening housing contraction are likely to weigh on economic growth over the next few quarters. Interestingly, the passage on inflation bears a very close resemblance to the inflation passage in the March directive. Essentially, the Fed is cognizant that some indicators of inflation expectations have risen in recent months, but it is sticking with its view that it expects inflation to moderate in coming quarters, reflecting a projected leveling out of energy and other commodity prices and an easing of pressures on resource utilization. The most striking omission from the April directive was the view expressed in March that, quote, downside risks to growth remain. This time around, the Fed simply noted that the substantial easing of monetary policy to date, combined with ongoing measures to foster market liquidity, should help to promote moderate growth over time and to mitigate the risks to economic activity. On balance, the FOMC wasn't as fixated on the inflation risk as we thought it might be, yet it seems to be feeling more comfortable with the economic outlook, as evidenced by the lack of express acknowledgement that downside risks to growth remain. In our estimation, this is a market-friendly directive that fits with our long-held position that overall economic conditions are not as bad as has been advertised, and that the Fed's actions in past months have indeed been preemptive in nature. With the fiscal stimulus due to kick in, the Fed is cognizant that economic readings are apt to improve over the near term. The sense one gets from the April directive is that we have hit the bottom of this rate-cutting cycle. That doesn't mean, though, either that an interest rate hike is imminent. The Fed, like the rest of us, is in a wait-and-see mode. Accordingly, it said it will continue to monitor economic and financial developments and act as needed. I'm Pat O'Hare for Briefing.com. Thanks for listening.